Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Tuesday morning, you're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. The markets are flying and they're raging and they're doing all kinds of things in a very, very fast-paced manner. Will the gains continue at this pace is the question now, which I think is logical to ask. So now, I think 6 days in a row the market's been up. It's got to be, the longest streak of win, at least in 7 months, if not longer now. I'm Prashant. With me, my colleagues Nigel and Surabhi. Guys, hi, good morning.
Hi, good morning. Morning, Nigel. Morning, Prashant. I guess no one's going to be questioning it or complaining because we got slammed so hard that this momentum on the way up just has been feeling, I think, very good across the street. But let's not forget, there is a gentleman called Donald Trump out there. Always makes life very interesting.
Well, give and take everything. You know, in January and February, everyone was pointing out that India was underperforming. Guess what? In March, we're outperforming. And that's a point to be noted as well, because after the stark underperformance, there are signs that we have been outperforming. Let's see how long it lasts. But good times for the markets, particularly the broader markets.
The broader markets. And I think last night, US also has rallied hard.
Yes.
So that is another point to note. Let's just sort of start there, right? So 1.7 higher on the S&P, then Nasdaq was up about 2.27%. I mean, the story which really moved markets in a big way, which was the underlying driver, was, of course, the weekend story, which we put out here the morning yesterday, which is the fact that the WSJ and the Bloomberg stories, which said that tariffs could be more targeted and less drastic. And that is, I think, ultimately what really was the tailwind for the market. Trump, of course, President Trump reiterated last night that I may give lots of countries breaks on tariffs. I mean, and then, of course, he threatened 25% secondary tariffs on nations buying Venezuelan oil and gas. It's just chaos, absolute chaos, a huge amount of uncertainty, lots of questions without even going into, the second order questions. I mean, even at the first glance, we don't know whether what will eventually happen. So, enormous amount of uncertainty. But the fact is that markets will stop reacting in a very sort of dramatic way if you have this news flow day after day after day. The only good thing is that we don't have to wait very long. 2nd of April is here. It's just around the corner. I mean, I think, next Wednesday is when we will find out what actually comes through. While there is a lot of uncertainty, I think the markets are getting a little tired maybe at the margin with all of the confusion, reprieve, go all in, etc., etc. So we'll find out. In any case, the S&P 500, by the way, in terms of that Venezuelan story, I'll just put that the graphic will come up again. Reuters says that according to Venezuela data from Venezuelan government, India has now become the 3rd largest buyer of Venezuelan oil and gas, oil basically. Again, we're reaching out to the ministry. We're talking to oil marketing companies here, and we'll try and understand what this really means. Now, the S&P 500, just to go back to prices, has closed above its 200-day moving average yesterday. So that's a sort of a Lakshman Rekha in that sense. The CBOE VIX cooled off almost 10%, back to 17 point something. The 10-year jumped, though, 9 basis points. And, we were back at about 4.34. Dollar index was up. It's been creeping higher. I think about 4 days in a row now. We're about 104.31. Slowly and steadily, it's coming back up. As we are getting closer and closer to the 2nd of April. I mean, tariffs are dollar positive. I mean, they are supposed to be dollar positive. They've not been dollar positive. Dollar's gone the other way. But so will some of that start to reverse? Technically as well, maybe there are some indications that perhaps there is a bit of a bounce coming. Oil prices were higher. 73 plus is where Brent oil prices left off at. So which gets us to levels and prices here where we've left off. So 23,600 is a number that we put out last week, Thursday, that the market should head to. Yesterday, we got to 23,600. In 2 days, I didn't think we'll get to it so fast. And we've closed above it. What is the 23,600 level? It's a 38% retracement of the entire fall from the all-time high of 26,277 to the low of 21,964. Even after this massive move, there is no signs of tiring or any reversal signals. And by the way, readings, especially on the technical side, at the margin are screaming overbought now with the kind of move that we've had. The next level is the February high on the Nifty, which is 23,807. That is the next number where perhaps there will be a little bit of supply which comes in. Support comes in at the hourly averages, which keep getting pulled higher as the market keeps running up. So 23,387 is the 20 hourly, and then 23,157 is the 40 hourly exponential moving average. But I mean, watch the 20, which is closer to 23,400, about 250, still 250 points away from where we left off. The Nifty Bank, I mean, I think, it's close to rallying 5,000 odd points from the lows. And again, it's done phenomenally well. I mean, here, the 61.8% retracement of the entire fall comes into view, which is 51,883. We left off at 51,704. And once the 51,883 number goes, then we're looking at potentially, the market opening up to the idea of a new all-time high. Support, like for the Nifty, comes in at the 20 hourly and the 40 hourly. 50,715 is the first support, and then 50,172 is the next support, which comes in for the Bank Nifty. Gift Nifty will come up on your screen, gives you a quick sense of how we are likely to start. 70-point gap up once again. And of course, as the market has shown last few days, it's kind of been, now you get into a bit of a tricky kind of a zone. Because it's been a clean run so far, and now you got some. We don't know if the 2nd of April is going to be a clearing event or it's going to be a risk event, right? So in that sense, as you get closer and closer into it, and with these gains in the bag, I think it perhaps gets a bit more choppy and not one way like we've had from the rally that we've had from the lows. Surabhi.
Yeah, absolutely, and which is why Asian markets are not exactly as bright a shade of green as Wall Street, because many of these markets, including us, we're on the receiving side of a lot of this chatter, plus, of course, the reality that's coming through. For instance, the Japanese market is holding up quite okay, but look at the Hong Kong market, look at China. Hong Kong's selling off big time right now. It's down 1.6%. I'll get to more of it in just a bit. Before we talk about tariffs and the implications of whatever Trump has said now on Venezuelan oil, Bank of Japan, one of the reasons why the Japanese market is not faltering is that the BOJ minutes are indicating that, yes, there are more rate hikes coming. The members have been fairly concerned about two things primarily. One, that the real rates in Japan are still negative. So that's the point of concern, which is why some of the members are arguing for the need to hike rates again. And second, the concern is on inflation. So this is indicating that this was just a pause that the BOJ was on. They will continue hiking rates. So that's something that's kind of playing out over there. Talking about the whole Venezuela issue, while Prashant, of course, mentioned India, and we are obviously the third largest sort of importer of Venezuelan oil, let's look at some of the other markets as well. China actually is the largest importer of Venezuelan crude, followed by the US. We come in at number 3, and then there is Spain. So these are 4 large economies that are importing a lot of this Venezuelan oil. And if there's, straight 25% blanket tariff, then obviously it becomes a little tricky. So continues muddling the water. So that's what we've got going. So international picture not as clean as yesterday. Let's see how we navigate it as we go forward. A couple of important local developments as well worth taking note of. One, very good news on the FPI front. We've got these flows coming in on a daily basis. Yesterday, what the market regulator has done, this is at the end of the SEBI board meeting, is that it has removed the uncertainty, the overhang that started way back in August 2023. That is when the market regulator had issued its infamous August 23 circular saying that all FPIs which have more than 25,000 crores in terms of total AUM in India, they must make granular disclosure right up to the last beneficial owner, complete see-through in the whole structures. This had unnerved a lot of people. There was a lot of back and forth, and then there was some talk about certain FPIs being exempt. Now the limit itself has been hiked to 50,000, and SEBI reiterated or explained why they've done it, because the market valuation has gone up several times. So they felt that it's the right thing to enhance that limit to 50,000 crores. So it's a blanket sort of, end of uncertainty on a whole range of FPIs. However, the concentration criteria has not been changed, which basically means that if your total AUM is more than 50% is in only one group entity, one Indian listed conglomerate, then you have to make additional disclosures. So overall, it's very good news on the FPI regulatory front. And the numbers kept coming in. Let's move to the fund flow picture. Yesterday, we got another 3,000 crores. Nigel, I completely take your point. The previous day, that 7,000 crores had the index rebalancing. Yesterday, again, we had 3,000 crores coming through. You can argue some of it is coming through a lot of the secondary market action that's picked up, blocks, QIPs, etc. But anyway, it's money that's coming in. Domestic institutions were also on the buy side, about 100 crores. Some news on banks. We'll tell you more details in just a bit. But again, it's good news, largely speaking. RBI has revised the priority sector lending criteria. Essentially, the two big headlines are that it becomes easier for housing sectors to sort of get more loans because the definitions or the limits have been enhanced for housing loans, and also for renewable energy, the definitions have been broadened. So it gets easier for RE entities to perhaps get more loans under the PSL tax. So that's good news coming in. And finally, lots of QIPs, like I was saying, lots of action. And these are the additional companies that are out there in the market to raise capital. We'll tell you more about them individually. But overall, looking good. Good news from RBI, good news from SEBI, and global picture not too bad.
Well, and what was encouraging yesterday is we had a big breakout yesterday, and the rally was led by institutional buying, not by short covering. So that was the big point in yesterday's trading session. After a while, no one-offs, no rebalances, what we saw. We had genuine buying coming in from institutions in the cash market, and that is heartening to see. What about the FIs do, though, on index futures? Well, they added some mild long positions, short positions as well, more longs than shorts in the ratio of close to around 8:1, which is encouraging, though they continue to remain net short with close to around 68% of their positions on the short side. On stock futures, though, there was a bit of a short covering bounce that did play out because the shorts were covered out by close to 9,000 contracts. Longs were added by around 5,000 contracts. A swing factor there of close to around 13,000 contracts. Remember, they have been net long on stock futures itself, but in yesterday's trading session, individual stocks did see a bit of a short covering bounce. The options data comes up for you on the screen, and now those call writers, they are running for cover. You know, the 23,500 call, 23,600 call. Big unwinding is what we saw there. They are packing their bags. They're saying, let's take what we're getting and let's get out of this market, because it seems now the momentum is with the bulls. And at the 23,500 put, we saw aggressive writing in yesterday's trading session, which gives us a couple of those reference points. On the downside, this becomes important support level because at the 23,500 put, there was writing. You also have the 100 DMA that's in this vicinity, so that becomes important on the downside. On the upside, the 200 DMA, that's going to be very, very important. 24,000 mark. This is the line in the sand. The bears will try to protect this level. Very, very important out there. The Nifty bank, that's the one that's broken out. It's conquered all technical levels, the 20, the 50, the 100, as well as the 200. In terms of a reference point, now the 200 DMA becomes a bit of a support zone. The 100 and the 200 DMA, which it broke out in yesterday's trading session, conquered the 200 DMA as well. So things looking good. Reliance Industries is holding one end up. The Nifty bank is breaking out. The important point is, will tech join the party? Fundamentally, we had a couple of brokerage notes that came out yesterday that said, maybe it's time for tech to now join the party. And if you look at it, you know, year to date, the tech index actually has been a rank underperformer. It's down close to around 14%, while now the Nifty is giving you positive returns for the year. And if you look at it on the technical aspect, you know, fundamentally, many brokerages believe things are looking good. But on the technical aspect, now the tech index is very, very close to its 20 DMA. So I think, you know, the tech index needs to participate if the markets need to move higher from here on. Stocks that I'm looking at, a couple of stocks because of a technical reason, they come out of the F&O band, Hindustan Copper as well as Polycab. We'll keep an eye out on both these two. Maybe post the recent run, taking some money off the table if you're a trader may not be such a bad idea. Let's see how this goes.
Okay, all right, got that. So maybe a little bit of a pause today, maybe some profit taking. Just take your breath to continue. Let's see if that's kind of a day. Well, let's start with the equity call of the morning. Venugopal Gare of Bernstein says that earlier this year, they had turned positive on the headline equity index as against a cautious view in the second half of last year. He says bottoming of domestic macros is central to that thesis. And as it is playing out, it is driving some recovery in equity indices. He says the next step is about navigating the global challenges, among which the risk of a US recession has emerged. He says their analysis suggests that India being a beneficiary of such an event. He adds, with domestic flows still resilient and FII outflows now largely done, they reiterate their positive view on the Nifty index with a year-end target of 26,500.
Mark Matthews is now with us of Bank Julius Baer and Company. Mark, good morning. Good to have you here. Prashant, this side. A rampant confusion about the 2nd April tariffs. You know, some relief, no relief. You know, will blanket tariffs, carve-outs, etc., etc. I mean, at some level of obviously, I mean, I think it's been a tiring 2 months or so since the inauguration, with at least headline chasing. What's your sense, Mark, as we get closer now to the 2nd of April? Will it be meaningful? Will it be everything on day one? Will it be phased in? What's your sense?
Well, Prashant, you're right. It is chasing headlines, which you're right. That's an exhausting thing. I think there's two ways of looking at it. The one way of looking at it is that they're just kicking the can down the road by coming out, every other day, it seems, with little tweaks. So, for example, the most recent one is that there will be flexibility, and a lot of countries will get breaks on the reciprocal tariffs, and some of the sectors will not have tariffs applied to them, like automotive and semiconductors and pharmaceuticals. To me, that's kind of kicking the can down the road, because what we want is certainty, and what we don't like is the uncertainty. So that's the negative way of looking at it. The positive way of looking at it, though, is last month Donald Trump said that, or he heavily hinted is maybe a better way of putting it, that he didn't really mind if the stock market went down, and maybe there could be a recession as a result of all the changes they're doing. It might be that he actually does care, after all, about the impact on the economy and the stock market going down. Because unlike Joe Biden, who was kind of, out of action most of the time in his presidency, Donald Trump is in the media every day, all the time. It's amazing how much he gets around. And so if the market does turn into a bear market, if we do have a recession, absolutely, he will be the one who gets the blame. Like Harry Truman said, the buck stops here. And so it could be one or the other. I don't know which it is. Either, it's sort of kicking the can down the road, or maybe he actually does care more than we think he does about the market and the economy. But on balance, my feeling is that this is a market that is going to churn for a few more months. There has been just far too much uncertainty created, and we're clearly seeing that starting to percolate through into economic data.
Yeah, but given what they've been saying, of course, some of his close aides, including Mr. Besant, caught the market off guard, saying short-term pain is fine and you have to fix the long-term issues like deficit, etc. So the image that they seem to be creating is that they don't care about the market. Well, we'll find out soon enough, Mark. Now, the question is that as, U.S. equities have been faltering, there's a change, obviously, in terms of the flow picture towards India. Do you expect a much bigger, wider move in the Indian market? Right now, we're just recovering from extremely beaten down levels. But do you expect a bigger India rally to build?
It's not just India, by the way. There's about 50 country ETFs listed in the United States, and 35 of them are up so far this year. So most of them are up, and the world, excluding the United States, stock index has returned about 8%. So India is just one of many countries that have actually benefited from this turmoil and people feeling that they don't want to invest in America as much, at least, as they did before. Many people had pretty much 100% of their equity exposure in the U.S. market before. And I think a lot of it is personal. I don't know if you've been reading about all these people who've been taken aside and detained trying to enter the United States, going through immigration, not just people from sort of Central America or South America, but Europeans, Canadians, being swept up into this strange immigration dragnet. And so, if you don't want to visit a country, you probably don't want to invest in it either. And I think that perception is helping the rest of the world. India, I mean, there's pros and cons. The pro is that it is the fastest growing large economy in the world. It will be the third largest economy in the world in a couple of years. So GDP growth in excess of 6%. You don't find many very large economies that have that. That's the pro. And the con is it's expensive. It kind of always has been, but now that it's bounced a little bit, we're back at, around 20 times forward earnings, which is a bit more expensive than the long-term average, actually. The long-term average, if memory serves me right, let's say over the last 20 years, is probably closer to 18 times forward earnings. So on the one hand, you've got great growth. On the other hand, it's not cheap. I don't know. I've always preferred growth over value, and I think that growth deserves a premium. So that's why we're overweight India, and we're sticking with that call. And maybe other people are starting to think that way too.
A valid point, Mark, and good to see you in as always. Mark, what about the dollar index? You know, the perception was that President Trump is going to be very, very good for the US markets and the US economy. Well, in the last couple of months, you know, that's got a little bit derailed. But what's played according to script, like we saw in 2017-18, is that the dollar index, once he took office, we did see weakening out there. And even out here, you know, in this year itself, we've seen the dollar index cool off from around 110 to around 104. How do you see that one moving out? Because from an India market perspective and an emerging market perspective, the dollar index is extremely crucial. Your take?
Absolutely crucial. Well, we've noticed the dollar has broken some very key barriers. It had upward trend channels for the last few years against many of the more cyclical currencies like the Canadian dollar, like the Mexican peso. So it's broken those barriers to the downside. And we generally think that will continue. I mentioned earlier, you know, that a lot of people just don't want to go to the United States right now, and they're not investing as much there. So if the flow of funds is generally in the other direction, of course, that would mean a weaker dollar. And the dollar is very expensive. I mean, if you just measure it fundamentally in terms of trade and Forex reserves and GDP growth, that kind of thing, it is pretty much the most overvalued it's been ever because it had been going up for the previous 4 years. So on balance, I would look for softness in the dollar, and that should be good, as you say, Nigel, for the broad emerging market asset class. All
right, Mark, we'll leave it there. Thank you very much for joining us. Appreciate it. And thank you for being here, as always. Well, let's just quickly run you through the interactions which are lined up here over the next 2 hours or so. So you'll hear from Greenply Industries at 8:35, and we talk business with them. How's the industry and the business looking? 9 o'clock, Prabal Sen of ICICI Securities will be with us. We'll talk about City Gas Distribution Company. Stocks were up 4-5% yesterday by close. 9:20, Krishna Sangvi of Mahindra Manulife Investments will join us in markets. NLC India at 9:30, talk about demand trends in the sector. We'll have the management of Titagarh Rail Systems at 9:40 to talk about if there's an improvement in execution and the capex picture from the government. A little later at 9:50, we'll have the management of Electronic Smart India and Retailers Association of India to talk about demand trends and the summer season sales that are picking up. Towards the end of the program, it's the economy. Lata in conversation with the head of Credit Bureau, CRIF, Hi Mark, to check out trends as far as bad loan formation is concerned. Stay tuned.
Well, time to slip into a short break. We've got a lot of stock-specific action lined up for you on the other side in our special Top 10 segment. We're looking at Cholamandalam Investment, Mahindra Finance, Ola Electric, Godrej Properties. There'll be stocks that will be reacting to positive news flow, while we have more stocks reacting to negative news flow. They include ONGC, BPCL, IOC, HPCL, Central Bank of India, and Restaurant Brands Asia. All of them will be lined up for you on the other side. Don't go anywhere.
Welcome back. The setup across Asia is a little more mixed. It's not as wide a green move that we saw on Wall Street. Some of the markets like Hong Kong are down. So it's a mixed picture. Now it's down about 2%. Remember, these are the markets that get hit with a lot of the tariff reality, as we will start to hear it from the 2nd of April. And the Venezuelan issue obviously is bigger for the Chinese market. China is the biggest importer of Venezuelan oil. But anyway, let's talk about individual stocks, and we have plenty to track this morning, and our team is standing by with the CNBC-TV18 list of top stocks to watch. Let's actually go across to Sudarshan. Start with him first, guys. Morning to all of you. Once again, Sudarshan, it's the oil and gas space making headlines.
Good morning, Survi. Yes, so now today it's on the back of US President Trump's announcement that he'll be imposing 25% tariffs on countries that buy Venezuelan oil, and that would be effective April 2. So I'm going with red on ONGC and oil marketing companies. Now, what's the reason? First, for oil marketing companies, one important point that has to be noted down is the most of the imports, Venezuelan oil imports that India did, were in 2023 or in early 2024. So 2024 imports that we did were of 22 million barrels. That formed 1.5% of our total imports. So it's not a big quantum. Now, why is ONGC in focus? It has subsidiary ONGC Videsh. First, it has 2 plants in Venezuela where company was expecting to increase that production. That might be difficult now. And second, ONGC was looking to get $500 million from Venezuela by getting more crude. That also seems to be very unlikely. Now, why oil marketing companies? First, they were not importing that much. But earlier, basically in February, oil minister had commented that India is looking to increase the oil imports from Venezuela, and that might be one of the reasons that we might take negative for OMC. And so, ONGC, oil marketing companies, in the red on the back of this news.
Okay, all right, Sudarshan, thanks a lot for explaining that to us. But let's hop across to Vivek. He's here to tell us about Restaurant Brand Asia and the central bank QIP as well. Morning, Vivek, take it away.
Good morning. That's right. So both of these companies in focus is on the back of QIPs that both of these companies have launched. Restaurant Brand Asia, remember Abhishek Kotari told us yesterday, and this particular news break has been confirmed. The issue size is up to 500 crore, where the base size is 400 crore, and another 100 crore is the upside option that the company may choose in case there is strong enough demand. The indicative issue price for this particular fundraise is at 60 rupees a share, or over a 6.5% discount to yesterday's close. Almost 16.7% equity dilution at that particular rate is what RBI or Burger King will actually see. The other stock on the radar is the bank, Central Bank of India. Again, a QIP that the company or the bank has launched. A company looking to raise close to 1,500 crore with an upsize option of close to 500 crore. The indicative issue price is at 40.49 rupees a share. Again, over a 13.5% discount to yesterday's close. The company will use these particular funds to augment the Taiwan capital base to meet further capital requirements. Expect both of these stocks to open in the red on the back of the significant discount being given.
All right, Vivek, thank you very much for that. Well, Ola Electric is the next one we want to put the spotlight on. Sud is here with more. Sud, morning.
Morning, Prashant. So first, before coming to today's disclosure, I'll give you the background. Ola Electric had one agency with the name of Rosmeta Digital Services. Now, company earlier this month had filed a plea in NCLT Bengaluru alleging default, and as per sources, the dues were in the range of 18 to 20 crore. Now, Ola has come out with a disclosure. It has disclosed to exchanges today. It's saying that it has settled all outstanding dues with Rosmeta Group, and also Rosmeta Group now has filed the plea that it will withdraw the petitions that it had filed before NCLT Bengaluru. Also, company is saying that matter with respect to Rosmeta Group now stands fully resolved, and that would be the reason that I'm going with green for Ola Electric for today's trade.
Got it. All right. Green on Ola Electric being a relative underperformer. This is clearly good news coming for the company. Let's wind this down with Vinny. She is here to tell us about Chola as well as Mahindra & Mahindra Finance. Morning, Vinny.
Good morning. So yes, we have Chola Investments that's in focus on the back of an appointment that has come in. Vilayan Subbai is now the executive chairman of the company. This is going to be with effect from 1st of April. Currently, he was the non-executive chairman of the company. Do not forget that he's been a part of the company, obviously, but he's been the MD of the company since 2010 to 2017 as well. So now, executive chairman role is what he'll be taking from 1st of April. M&M Finance, we are seeing that there's an appointment that has come in of Ram Ganesh Iyer, who's as a Chief Operating Officer. This is going to be for the 10th of April that we're watching out for. And overall, he's got a good experience in the field of financial services, consulting services, as well as entrepreneurship. And it'll be an interesting one to watch out for. So we are expecting green on both these stocks as well.
All right. Godrej Properties is the next one. Vinny, you want to sort of wrap that up as well?
Yeah, so Godrej Properties, we're expecting green here. Now, do not forget that in Jan, they'd launched one of these, properties in Hyderabad. This was their first launch in Hyderabad, Godrej Madison Avenue. Now, they've sold around 300 homes in that property, and 1,000 crore sales is what they've done so far. So, an interesting one that we're watching out for from the company, especially strengthening their presence in Hyderabad is interesting, and we're expecting green.
Okay, thanks, Vinny, for that. Well, here's a quick recap of all the top stocks with positive news flow. Chola Investment, Mahindra & Mahindra Finance, Ola Electric, and Godrej Properties. Well, the ones with negative news flow, they include ONGC, BPCL, IOC, HPCL, Central Bank of India, and Restaurant Brands. From the equity space, let's move to the commodity action. Manisha Gupta joins us to help us out with exactly that. Morning, Manisha.
Morning, Nigel. Thank you for that. I'll start with the crude oil prices, where we are trading at a 3-week highs above $73 a barrel. Well, Trump has announced 25% tariff on any country that buys Venezuelan oil. And China is a major buyer of oil from Venezuela, and that is a premium that you are seeing in prices. Apart from that, it is also going to be about the OPEC and allies meeting, which is on 5th of April, where they will decide on whether or not to increase output for the month of May. So that's going to be an important event to watch out for. Another important event is going to be the U.S. PCE data that comes in on Friday. Ahead of that, we have seen the dollar index hit a 2-week highs, and that's weighing on the gold and silver prices both. But what is continuing to trade well is the metal as a sector. Copper very close to its all-time highs, and you have zinc prices also trading at a 3-month highs in Asia right now.
All right, Manisha, thank you very much for that. So that is what's happening with regards to oil and commodities. We'll take a quick commercial break here. We're going to come back. Amnish Agarwal is going to be with us. If Prabhudas later Capital, we talk some stocks. Lots coming up. Stay tuned. Okay, welcome back. Let's just talk about what's happening with regards to some news flow now. RBI has issued revised priority sector lending guidelines. Lata is now joining in with a quick snapshot view of what these would mean. Lata, good morning.
Good morning. The Reserve Bank, from time to time, amends these guidelines. Priority sector, as you know, 40% of all their deposits banks must lend for specific goals like, farming, weaker sections, affordable housing, etc. Now, they have to be revised primarily because of inflation. So what you call, say, what was a 30 lakh house now is not affordable unless you pay 40 lakhs. So those were the guidelines. And that's why I'm saying that it doesn't makes life easy for other banks, but for HDFC Bank, it becomes much easier because they have a large housing book. So let me come through the reasons, or let me get through the changes. First one is limits on housing loans. The price limits have been increased. So in cities with less than 1 lakh population, less than 10 lakh population, less than 1 crore population, it changes. And for each of them, the limit has been raised by about 10 lakh. And that makes it easier for banks to find people who are building those kinds of houses. So basically, ease of business for banks. They've also broadened purposes under renewable energy. That's because new products have come. And therefore, you want to redefine and allow new products. Also, for urban, this is important. Urban cooperative banks, they had to give 75% of their deposits. Now, it has been reduced to 60%, but not any listed entity, so we don't have to bother. Expansion of the weaker section definition so that more people become eligible. Even women who take up to 2 lakh loans get included in this. So that again makes it easier for banks to find people and therefore fulfill their priority sector loan obligations. There is also a very helpful list of districts with very high PSL and very low PSL. So again, this is a moral suasion for banks to lend in those areas so that the priority sector fulfills the social obligations. So basically, I wouldn't think that banks get green because of this, but it certainly makes life a little easier for banks. Many of them, like RBL, even State Bank, often don't fulfill that 40%, and they have to buy PSL certificates from others who have fulfilled. Now, this becomes a little easier for them.
Right. Absolutely, Lata. Thank you very much. A very useful and concise explanation with regards to what has happened there. Now, from one sort of regulatory sort of easing to another, SEBI's eased disclosure rules for foreign portfolio investors after Tuhin Kantapande's chaired his first board meeting yesterday. Sandeep Parekh is now joining us to talk about this and more. Sandeep, good morning. Good to have you with us here. Prashant, this side. Easier disclosure rules for smaller FPIs. How significant is this, according to you?
Hi, Prashant. So I think it's I would say it is definitely a change for the positive in terms of changing the number from 25,000 crore to 50,000 crore. I would have actually wanted another thing, which really is, allowing exemptions based on good evidence. Because, we've seen, multiple clients and other people that I've met, many FPIs are being forced to kind of wind up their positions because they're unable to go to the last natural person without any, de minimis rule, which means even if you have $100 in a fund, you have to go to the last person, which is not always practical or possible for funds which have, hundreds of investors. So I think an additional change would have been very, very useful so that, we don't get rid of clean money, right? We want clean money. We don't want press note fee violation. We don't want minimum public shareholding violation or any other violation. But at the same time, we should not get rid of good money.
Okay. But this will help at the margin, Sandeep, in terms of what is needed, as you said. You've pointed out that clearly. But what has happened, perhaps step in the right direction?
I think it's a step in the right direction. And if you see all the other agenda, the decisions from yesterday's agendas, I think almost every single one is getting into deregulation. I think there's pretty good news directionally, and of course, those are steps, still small steps. But I think the point of number one, deregulation, number two, transparency at SEBI, I think great signals to the market.
Anything apart from this which really stands out to you, which you thought was
so another thing which one of the things which stood out was the merchant banking regulations, debenture trustee merchant banking, which actually reverses or rather stays a decision by SEBI in its previous board meeting, where they wanted to kind of make merchant bankers divest unlisted work that they do. So if any advice that they give for unlisted securities, debt securities, or any such thing that had to be divested, which actually didn't make too much sense, because then you'll have two merchant banks of the same family doing pretty much identical stuff, one for listed space. So they put that on hold, which is great, I think. And I hope they kind of, I don't think it's precedented anywhere in the world to have an unlisted company merchant bank and one listed company merchant bank. So I'm glad they paused that.
Okay, Sandeep, quick initial top-of-the-mind thoughts there, but good to get those. So most decisions, and that's the broader takeaway, the broader message, most decisions from SEBI yesterday point towards deregulation and ease of doing business, both for foreign investors and, of course, locally here as well. So that's the first board meeting under the new SEBI chairman, Tuhin Pandey. GIFT Nifty will just come up on your screen. There's still 20 minutes to go as far as market open is concerned. At 8 o'clock, when we looked at it, they had we saw almost a 70-75 odd point pop. And I'll give you a sense of where we are now exactly. Almost pasted the 70-point gap up. Very much still there. 23,770 is where we're at. Nigel.
All right. Well, let's get in, let's get a little bit more fundamental analysis going. We have Amnish Agarwal, the Director, Institutional Research at PL Capital, joins us. Hi, Amnish. Thanks a lot for joining in. Well, the oil and gas space, plenty of news flow, right, overnight. Trump, wrapping those who are going to take oil from Venezuela on the knuckles. And also we have news that there could be some light at the end of the tunnel on the LPG recoveries as well. How are you viewing the oil and gas space? For starters, maybe the stock start off negative, both the producers, that's Oil India and ONGC, as well as the OMCs as well. Do you think it's a buying opportunity?
You see, the situation remains volatile because, first of all, the crude is actually, for example, fluctuating. But I think this news on Venezuela in particular, I think it is going to be negative for many OMCs which have been actually importing crude from there. So to that extent, I think there your margins can come under pressure incrementally. And what was the second part of your question?
So how do you approach them? These stocks are going to start off in the red. As you're saying, things are very, very volatile. But if you look at the OMCs, they seem to have got their mojo back. If not mistaken, the stocks are up 15 to 20% from the recent lows because of lower crude prices, valuations, and also the margins now are much better than the historical average, as well as what the street is factoring for FY26. Your take?
You see, OMCs, you can't look at, like, for example, a structural fundamental stocks because in there, for example, month on month, quarter on quarter, your your refining margins, marketing margins, they will continue to fluctuate. But having said that, the lower crude prices are going to benefit in the near term, and that is why there has been some rally in the OMC stocks. So in the near term, unless until we are clear about what happens on the Venezuela front, to what extent it is going to impact, there might be some more steam left in these stocks. But it is purely, I would say, like you can say, a trading call, and very difficult to watch what is going to happen 1 or 2 quarters down the line.
Okay, all right. Amnish, what about the tech space? You know, the IT index has been a relative underperformer. Now, various brokerages are pointing out that maybe bulk of the bad news is in the price. To give our viewers a data point, the Nifty is up mildly now in 2025 so far, while the tech index is down 15%. What's your view on tech from here on, given that we have earnings in the next 20 days or so? We'll have most of them that will report their numbers. And what's the pick of the pack?
Is a tech, actually the demand continues to be benign for all the tech companies, and the commentary also is not great. Now there are 2 parts to it. For example, Europe was already witnessing a slowdown, and if the current, you can say the positioning or the current whatever news we are getting from US, I think that there could be some pressure incrementally there also. So I think if you are looking at, say, a tech space, there is not a significant improvement which is likely in the near to medium term over that space. So we expect that in tech space, you might see, say, low to mid single digit kind of a cut in earnings as we go along. And I think that is perhaps what the stocks are also reacting to it. And given the global uncertainty, the kind of, you can say, the trade wars which are on the horizon, and the kind of news flow which we are getting, I think I would be very reluctant to stick my neck out and go overweight on tech at this point of time.
Okay. All right, Amnish, got that. Thanks very much. We also have a management waiting by. The spotlight now is on Greenply Industries to talk about how the business trends are shaping up as we're almost winding down the year. Manoj Tulsian, Joint MD and CEO at Greenply Industries, is with us now to take a couple of questions. Thanks very much, Manoj, for joining in. So, you know, we're in the final leg of the year. Let's start by just getting a basic sense of how Q4 has shaped up in terms of volumes, in terms of pricing, overall demand. What has that meant for both the segments, MDF as well as plywood?
Thank you for having me on the show. See, Q4 numbers won't be able to speak on details, you know, because of the regulatory things. But I can give you a picture of the overall year. You know, the overall year, if you really see, demand has been slightly tepid. But more so, the challenge which we have faced in the last 3 quarters has been liquidity concerns. So even in pockets, when we get to talk to our channel, you know, they show about demand, they are not able to pay us on time. And that is one discipline which we have been hearing across the segment, not only panel, but even in other building material products. When we are talking, we are finding that liquidity has surely become a concern. I think that is one of the reasons also that somewhere the growth during the year is getting hampered. Quarter 3, quarter 4, if you really look at, you know, on the real estate side, when I look at data points, I find that the numbers looks good in pockets, but somehow we don't know. I mean, you people are the best people to, you know, answer where is that money gone from the system. You know, we all believe that after a union election, there's a lot of money which flows into the country, I mean, you know, on the consumption side. And normally the years behaves very well.
Manoj, just to get that the clarity on that point, what you're saying is that liquidity concerns have hit you. Are you talking about, you know, in terms of overall payment cycles, receivables? And now I guess that should be easing up, right? Because the RBI has taken a very different approach in the last couple of weeks. So overall volume growth for the year, I mean, what are you looking at?
No, the volume growth has not been in line with, you know, what we guided. And as I said that, you know, clearly, yes, it is on the receivable cycle, not getting the payment on time, which means that, you know, either we break that discipline and, you know, get into that, the rough side of it. But I don't think that's a very feasible way of looking at things from a long-term perspective. We have corrected many things, you know, which was a concern in the past. So these are, you know, short-term hiccups which we are willing to look at. Because I can clearly see that, you know, in the going forward, in the next 2 to 3 years, things looks to be very, very good. You know, especially because of the implementation of QCO, things will change dramatically. and I can clearly see a shift which can happen from the unorganized to the organized market. So, that's the tailwind which we are able to see going forward.
All right. Hi, Mr. Tulsian. Good to have you as always on the show. Give us a couple of details. Let's focus on the plywood business itself. Century seems to be growing at a faster clip. So if you could tell us, what is your market share? Have you lost out on market share out there? Point number one. Point number two is margins, you've gradually been improving it just in the plywood segment. Do you see it head to around that 10% odd mark, double digits is something that we should be working with for the coming year since things will look up? Please go ahead.
So Nigel, first I'll come on the margin. If you really see, our margin has been in single digit. Yes. Though in the last quarter, after the results, I've given a commentary that, definitely now we have worked internally on a few things. A few places we have taken price correction also. So the margin looks like it will go back into the double digit. Having said that, one very important point which I want to bring to the notice of everyone is if you really see our A&P spend in the last 3 years have gone up by almost 1.5 or 1.6%. Earlier, we used to spend around 3% of our total sales as A&P. Now it has gone to close to around 4.5 to 4.6%. So that's the additional investment which you made in the business, because if you really see, we were only into plywood business at one point of time. And then we also got into MDF. Now we have gone into hardware also. So the brand overall needs to be strengthened. This is a good investment which we have started doing. Now that we know that we are at that level of investment, maybe for one more year or a couple of years, we might have to remain at around 4.5%. We started working now internally on the efficiency parameters. Okay. And also, I think that the next best trigger will also come in the coming year, because last 4 to 5 years, you will see clearly that the timber prices were only going up. Now we get a sense from our plantation team that, that is possibly looking like the end of the cycle of the prices rising. There would be new supplies which will be coming during the year. For sure, around Q3 is what they are promising.
So, Mr. Tulsian, Mr. Tulsian, just to confirm, though your A&P spends have gone up, you have the benefit of lower timber prices, which will help you. So we see double-digit margins in FY26. Is that the goal?
In plywood business, for sure, yes. MDF, in any case, we are doing very well in terms of margin, but plywood also, yes.
Okay, all right. And market share? Have you lost some market share? Do you want to pull that back?
Well, yes, of course. I think we are prepared as a company now. In 3 to 4 years, there has been a lot of rigor which has gone. There was a lot of focus which has also gone in setting up MDF as a business entity. Successfully, we were able to do that, and we were able to ramp up. Then the next challenge came is again getting into a new line of business, which was hardware, furniture hardwares. That also successfully, the plant has been set up in the fastest time. The production has started. So, not much focus will come back to our bread and butter business, which is plywood. So once that happens, and since, many of the internal things in terms of building up our processes, system, automations has worked quite well, I think we are very well prepared now to look at a good growth, including the margin improvement.
So double-digit volume growth in FY26, right?
Looks possible, very much possible.
Very good speaking to you, Mr. Tulsian. We have not got too many numbers out of you, but we've got a broad sense in terms of how you see business evolving. We look forward to chatting up with you at the end of Q4 numbers and then press you a little bit more for numbers for FY26. Wishing you a good day ahead. Well, time to slip into a short break. On the other side, our technical experts are waiting for us. Welcome back. You're tuned into Bazaar Morning Call. As promised, our technical experts are waiting for us. Mitesh Thakkar and Sudarshan Sukhani. Hi, gentlemen. Good morning. Thanks a lot for joining in. Mitesh, go first. Is the party going to continue? What's the level on the Nifty you're looking at? What would the trade be, given that we're going to start off with a gap up of around 70, 80 points?
Morning, guys. I believe so, we'll see further hikes. See, again, the question is whether we'll keep moving up or whether we'll have a pullback. I think we're quite stretched too far away from the short-term averages, so the chance of a pullback is always there. But I had a similar view yesterday, and there was no kind of, there was no decline or intraday pullback which happened. So trade with a long bias, but now for the next few days, trade with tighter stop losses and slightly lighter quantities. Once you get a dip, I think that would be a wonderful entry point and we'll see much higher levels. On the bank Nifty, I think I'm now looking at 52,000 as the first target and then 52,700. While on the Nifty, I think, I'm looking at about 23,800 as the near-term target. And in case we start getting past that, in a good case scenario, even 24,000 can be scaled and we can look at 24,150, 200. So the targets are there. The pattern and the structure suggests that we'll see higher levels. Just tactically, you'll have to position it and, be long, but be aggressive once you get an intraday or a one-day kind of a pullback.
Okay, well, will we get that pullback is the question. And, interesting times, really. Big moves from the lows. What next? Gentlemen, morning. Sudarshan, to you next. By the way, at the margin, are some of the near-term indicators getting a little overbought? The point is these signals, when the market was selling off one way, it didn't work, right? I mean, the market kept getting more and more oversold, but the selling continued. They need not work on the way up as well. If there is some cash buying, which is returning at the margin. What's your sense, Sudarshan?
Yeah, good morning. No, they will not work. It's not just need not. There is no concept of an overbought signal or an oversold signal, except in very narrow range-bound markets. This is not a range-bound market. So we should simply ignore this overbought concept here. The market is in a strong trend. Trending markets can go more than we can imagine, as we've already seen. Nobody thought we would have 1,700, 1,800 points of a rally in 20 days. But my view now is, yesterday I said go and buy, and we had a spectacular day. That was just lucky. I think the markets will now take it easy. Two things have happened. One, yesterday the market was anticipating a big rise in the US markets. Early pre-market signals were there, and we anticipated it. Second, March ending is usually a time when there is this decent window dressing going on. Every March you will see it. That will end on Friday. So I would expect the markets to consolidate now. I don't think we are going to go down. It's not so simple that markets go up, wait patiently. They will come down significantly and we can buy. Markets are never so easy. Expect a series of days when consolidation takes place. So for those who are long, this is a time to take profits and step aside. For those who are not long, use small dips to take trades, but I don't know whether those dips will work out or not. Primarily expect a consolidation which becomes choppy, start planning to take profits.
Okay, all right, gentlemen, stay with us. We want to hear your picks, but for the time being, we'll slip in a short break. We'll be back. We'll get you pre-open rates. We'll also be joined by Prabal Sen of ICICI Securities for a view on the oil and gas space.
Welcome back. So we're just about approaching 9 o'clock. Let's quickly get some trading ideas in then. Mitesh and Sudarshan, of course, with us. Gentlemen, morning. Once again from my side. Let's talk about stocks. Mitesh, what are you working with?
Good morning, Sobi. I have all buy calls. A buy on Punjab National Bank with a stop at 94 for targets of 100. Bosch India has given a reversal after a long time. That's a buy with a stop at 27,800 for a target of 29,000. Nippon Asset Management is a buy. Keep a stop below 576, look for targets of 620, and Power Finance Corporation is a buy with a stop at 419 for targets of 436.
Okay, got that, Sudarshan. What about you?
Well, it's an all-buy list. The idea of shorting this market is horrible. So we start with Hinge Unilever, buy with a stop under 22.19. Zydus Life, buy with a stop under 907. Info Edge, that is Naukri, buy with a stop under 69.48, and Inside Industries, buy with a stop under 358. Yesterday also I explained that there is a sense that small caps and mid caps are slowly rising from the ashes. We'll see.
The pre-open is kicking off, and so we've got about 100 points on the Nifty, 23,770 or so. The sensex is at about is up 630 points. Let's look at Reliance Industries and the oil marketing companies. I've seen some pointing out that how there is perhaps Reliance and OMCs perhaps will get impacted because of this Venezuelan oil issue. But the fact is that in terms of the Venezuelan exports, which by the way in any case are heavily curtailed of oil, India is now the third largest buyer according to Reuters, but it is a percentage of our own imports. I mean, it's a very small percentage, very, very small percentage, which can be, I reckon, replaced with oil from other sources. So, some commentary around this, but I think you should keep that in mind. To my mind, it's not a big negative or anything of that sort at all for OMCs or Reliance, which of course has got the most efficient refinery to process that heavy crude. So those are names up on your screens. Mitesh and Sudarshan will talk again. Amnish is with us. Amnish, thank you for waiting. Any thoughts on this issue if you've looked at it?
Yeah, which one? This oil one?
The oil imports and Trump saying that 25% tariffs on anybody buying oil from Venezuela. Any implications for Indian companies?
Yeah, you see, the main thing is that India has been increasing the imports from, you can say, Venezuela, if you look at, say, past few years. And whenever you get a cheap crude imports, then actually it reduces the overall basket price to some extent. But having said that, now the kind of, you can say, duties which have been imposed by US that anyone who imports, they will be facing the duties, I think that advantage actually goes away. But the number is not big enough for India to worry that it is not maybe say double digit of our imports or something. I think it is hardly 1 or 2% of imports, which India can easily shift to other sources. But having said that, it actually might push up your overall cost shade. That is one. And secondly, it narrows down your choice to some extent, which might have even implications not only on India, but some of the other oil importing countries. So to that extent, I think there might be minor variation here or there, not a you can say big one, unless and until we realize that there is that the bulk of imports are going to, you can say, one single player, and so that might be one issue with one player. But otherwise, I think not a big needle mover as far as India as a country is concerned.
Okay, all right. Thanks a lot, Amnish, for joining in and filling us in with all that fundamental analysis. But let's stick with this topic. The oil and gas stocks, they're going to be in focus. Remember, yesterday, we had gas stocks that were on fire on the PNGRB proposed amendments to the gas transmission tariff regulations. And today we have news on the curtailment put on Venezuelan oil. Prabal Sen, the senior research analyst at ICICI Securities, joins in. Hi, Prabal. Thanks a lot for joining in. Give us a few details. What's the percentage of imports coming in from Venezuela for India? We understand it's relatively small. Do you see this as a risk?
I think, while exact real-time data is difficult, but my understanding is that India imports close to about 0.2 to 0.25 million barrels a day of oil from Venezuela. When you consider that India's total imports are in the range of around 4.5 million barrels of oil per day. Obviously, it is a relatively small percentage compared to the percentage from, let's say, Middle East or, even Russia, for that matter. But the fact is that if, the condition for avoiding this additional 25% tariff is that this oil will have to be replaced, then that's an additional sourcing that you will have to find from somewhere. And, to basically find 250,000 odd barrels of oil per day is obviously going to, take its own time. But from a supply security perspective, I guess because it's less than 5% or less than 4% of our overall crude slate, it's something that I think India can figure out how to basically, manage this hit from what we get there.
So not a big challenge on this aspect. Another aspect, I wanted to focus on is the OMC LPG losses. And now there's a couple of reports, by Money Control as well, that state that those, that under recovery could actually, there could be some lighter day on that. I think for the first 9 months, it was around 30,000 crores or thereabouts. Are you factoring this in your estimates? What realistically should we be working with in terms of some compensation for these LPG recoveries?
No, actually, I think, we were pretty hopeful that it would come through in the budget first. And then there was also this news that in the supplementary provisions that were basically announced, it would have some, good news as far as the OMCs is concerned. But as of now, given the uncertainty in terms of exactly the quantum and the timing of this compensation. We frankly are not really building it into our FY25 estimates. As and when it happens, it's something that will probably be more of a positive trigger as far as we are concerned. But right now we are assuming that the 40,000 crore odd of losses that are due, if you build, another 10,000 crore odd in the fourth quarter, I think that will have to be absorbed by the OMCs, at least for this financial year. That is what our base case is.
We'll talk about city gas in just a bit. Prabal, hi, good morning. The standalone refiners, actually Chennai Petro has seen one of the sharpest rebounds in the broader markets, up some 35% from lows, MRPL as well. How's the picture there for these two names? What's the environment like?
We don't track CPCL and MRPL separately. We don't have an official view or rating on it. But what has obviously happened is, if you see the direction of Singapore benchmark margins, they have definitely improved a bit. And specifically, diesel spreads have once again been hovering at somewhere between $13 to $14 a barrel. And that is always good news for Indian refiners, given that close to 50% of our product slate comprises of diesel. And if you consider gasoline and ATF as well, the total proportion is close to 67-68%. I'm talking about average for Indian refiners. Each individual refiner might have a different percentage. But given that whatever strength is coming through in Singapore is being driven by these three benchmark fuels, whatever strength is coming through is obviously good news from a refining margin perspective, because if Singapore is at $4, but it is being driven primarily by strength in diesel and ATF and gasoline, I think Indian refiner margins will obviously be at a premium to that. So to that extent, definitely it's slightly better, directionally than what Q3 trends were for GRMs. And remember that, probably, given that crude volatility has been slightly lower, your inventory impact could also be much lower in this quarter. That is also something that can help reported margins.
All right, Prabal, so that is the standalone refiners, and I completely understand you don't have a view in terms of actually coverage on these names. City gas companies, IGL, MGL, Prabal, what's the view there?
I think, given after the restoration of part of the, priority gas and the way that, gas costs have been moving, we would probably continue to remain positive on these names. I certainly think that, volume growth has continued to surprise on the upside, specifically for MGL and to a lesser extent for IGL in the last couple of quarters. Gujarat Gas, of course, it's a different story because, it's driven a little bit with what ceramic industry is doing, what export trends are as far as ceramics from Morbi are concerned. So the constraints could be a little bit more external. But certainly from a CNG conversion and volume momentum point of view, I think despite all the constraints that are there in terms of slightly higher sourcing costs and a more challenging gas supply environment, I think the conversion rates and the volume run rate probably continues to surprise, and I think that momentum should continue with the partial restoration of priority gas. What will be, of course, interesting is to look at spot LNG trends, because what is interesting is for the first time in probably a very long time, term LNG prices are now much cheaper than spot LNG and are likely to probably remain so for at least the next 3 to 6 months. So the key to success or the key to margin strength probably would be whichever player can probably tie up much more of contracted long-term volumes rather than having to rely on spot LNG to fulfill the shortfall from any priority gas deallocation or any incremental volume growth. So I think that is something that will be key monitorable at these prices with the kind of volume growth, and I think margin looking slightly better than they were 3 months ago. We would remain positive on the space.
Prabal, just 30-second response to this. We were supposed to have a gas glut. So even without these long-term contracted volumes, spot prices, at least from what I remember, beginning of the year, late last year, reading, we're entering a period of a lot of gas. Prices generally, spot prices should be lower. You think?
I think we have seen this story before. If you remember a few years ago when Australia was coming up, as an LNG export destination. This was exactly what was being speculated, that there would be a huge gas glut and, prices would drop to low single digits and stay there. What really happens is that when prices drop below a certain threshold, the market tends to correct itself in terms of probably delays in commissioning of new projects. There are, shutdowns that happen in projects which don't find it economic to sell at sub $10 levels, and so on and so forth. So to that extent, I think there is always a minimum threshold that spot LNG prices need to be at for these projects to keep running at full tilt. That's one. Secondly, what has happened this year is that the European gas inventory has actually fallen a little bit faster than what has been the trend over CY 22 and 23. So that has impacted the near-term balance in terms of supply and demand. I would still believe that with the capacity expansions that are targeted over the next 2 to 3 years, where I think 190 million ton plus of additional LNG liquefaction is slated to come online by CY 28, you would probably see a normalization and moderation in prices. But in the near term, there have been specific factors that have impacted spot prices, and that's probably why you're seeing them remain elevated probably a bit longer than what earlier estimates were. We would remain confident that spot prices would probably normalize to somewhere around $11-12, but we have never advocated that prices go below 10 and stay there, because that always brings about a swift market response from the supply side to correct it upward. And I think that's something that will continue.
Okay. All right. Prabal, thanks very much for the context and the perspective. Appreciate you joining us today. Thank you very much. Have a good day. Let's quickly revisit the pre-open rates. And now we've actually still got a nice 90-point upswing in terms of the gap up. And the mid-cap index is also on the higher side, at least for the time being. So green is still very much the color. Let's quickly take some final trading calls with our experts. Sudarshan, so what would you go with?
I'll go with Exide Industries. Buy Exide with a stop under 358.
And Mitesh, what about you?
I'll go with the buy on Nippon Asset Management for targets of 620.
Okay, all right, gentlemen, thanks a lot for that. Well, let's focus on the cement space. This after UBS has gone ahead and upgraded the cement sector. They believe that the rough patch is coming to an end. And so they've upgraded Ultratech, Ambuja, as well as Dalmia to buy. Remember, UBS had a negative view on the sector all the way since July 2023. The key reasons they cited back then was that competition was rising, demand slowed down because of the general elections, and also the rising price competition post Adani's entry into the cement space. Now UBS, they've done a U-turn. They are turning positive. They anticipate earnings upcycle to emerge in FY26 with strong EBITDA growth in the next 2 fiscals. Their positive stance is backed by demand revival, which is driven by housing upcycle and the revival in government capex as well. The other part they are pointing out is the structural cost-saving factors that will play out, and the initiatives that have been taken by companies which will drive margins. Bottoming of prices is another thing that they're looking at after the dismal prices we have seen in the first 9 months of this fiscal. The sector consolidation has been led by the top 2 players, that's Ultratech as well as Ambuja. The reasons for upgrading various stocks is as follows, and the chart should come up for you on the screen. Ultratech, well, they have shown strong execution in tough times, and they've led industry both in growth as well as on margins. Their top pick, though, is Ambuja due to its high growth and lower valuation. While on Dalmia, they have done a complete U-turn. From a sell rating, now they have a buy rating. While on ACC, they had a buy rating. They're maintaining that. The factors they're citing is supportive valuation as well as industry tailwinds. Put all this together, UBS, after being cautious on the cement space in the last couple of years, they've done a U-turn. Now they have buys on a whole host of stocks. So we'll keep an eye on those stocks.
Okay, well, just a minute to go for the market open. What do we have? First rates will start to come up. 90 points higher on the Nifty in the pre-open, 300 on the Nifty Bank, the sensex, beg your pardon. And there you go. I mean, we're at about 23,753. The February highs are slightly above the 23,800 mark. The Nifty Bank is up about 1/3%, 51,875. You've got the mid-cap index, which is up 0.6%, and the small-cap index, which is, I think, up about 0.5% plus as well. And like we've had for a few days now, market breadth right out of the gate, super strong this morning. And the BSE advanced decline is up on the NSE as well. So 5-1 in favor of advances in the BSE, and much stronger on the NSE as well. But just sort of these are opening rates. We'll have to give it some time. The Nifty heat map will come up on your screen, gives you a quick snapshot view of how things are starting. So it's, I think, a replica of what we saw yesterday. Majority of the names are higher and about 10, 11 names are starting the day lower at this point. I think the Ultratech is, I can see on the gainers board, as Nigel was pointing out, that upgrade coming in on cement from UBS. Surabhi.
Absolutely. So it's looking good, 100 points higher on the Nifty and far more green than red today. Apart from Ultratech, Ultratech is, of course, the biggest Nifty winner at this point in time, 2.5% hhigher. IT is off to a good start. HCL Tech, Infosys, TCS, all these stocks are up and about. Banks are chugging along quite nicely. HDFC Bank about 0.6, 0.7% higher. There's some green on Axis Bank as well. Kotak Mahindra Bank also on the positive side. So banks and IT look fairly stable. L&T is notching up a gain of about 1% or so. Some of the auto stocks are seeing a little bit of buying as well. Hero Moto, Tata Motors, Maruti, M&M. So not too much, but just about 0.5% on all of these stocks. So not too bad. On the flip side, Dr. Reddy's is lower by about 1.5%. Britannia, there's some labor issue. There's a strike at one of their plants, I think in Gujarat. Stocks down about 0.5%. IndusInd Bank is seeing some more pressure after yesterday's 1.5% fall, another 0.5% today. And some of the steel counters are a little careful this morning. Tata Steel, JSW Steel, Hindalco, all the steel majors are down about 0.5%. Reliance, Lever, these are the fence-sitters, the big boys, not doing too much. But at least many of the banks and IT on the positive side looking good.
Well, that's right. EIL and RVNL, both those two, they have one order. So that's why both those two stocks have opened up in the green. Suzlon, there's an initiating coverage that's come in from Motilal Oswal. They have a big target price out there, and that explains why that one as well is doing well. It's up close to around 2% or thereabouts. Colgate, I've seen a report coming in from Investec, and they are talking about earnings deceleration likely to continue on Colgate. So that explains why that stock, in fact, is down close to around 3%. Could be weighing on the stock. Colgate, one of the big losers this morning. On the flip side, what's doing well? Ramco Cement's up. Ambuja Cement's up. Both those two participating as well. Ultratech obviously is the big gainer. Polycab, we had highlighted earlier today that one's come out of the F&O ban. That stock is up close to around 2.5% or thereabouts. So good move is what we're seeing on that particular name. Ola Electric, well, they have settled the dues with Rosmata Group. So on the back of that, you have that stock as well that's doing quite well. IRIDA, the stock continues to see its good run. Remember, it saw a sharp correction from the peak. Now, in fact, that's bounced back. And ITC Hotels as well. That one's gradually hovering around the 200 rupee odd mark. The sector of the day, though, to start off with, is the cement space. All the stocks doing quite well. Relative underperformance is what we're seeing. Dalmia, Ultratech, Ambuja, all of them firing all cylinders.
All right, absolutely. It's a solid start for that particular pack, as we've been sort of highlighting and pointing out. The number one volume-led gainer right now is Garden Reach Shipbuilders, GRSE, which is up 3%, 1754 on Garden Reach. And I mean, that defense pack is done phenomenally well in terms of just bounces. Garden Reach is one. I mean, look at names like even smaller names, private companies, Zentech, for example, Cochin Shipyard. HAL has come up very sharply as well. I think HAL is up about 25% from the lows. It's done less as compared to some of the others in that. BDL is another one. So, yeah, I mean, massive moves, very, very short time span, like Spring Coil, right? I mean, Zentech, I think, is up another 5%. 1,600 is back on the rate on Zentech. The high, I think, was close to about 2,600. So, yeah, I mean, a fair bit going on. What else? I mean, maybe this IGIL, I think it was up 5 yesterday in the morning as well, I remember. That's the diamond certification company. So it's coming up almost back at 400. Brigade is up 3.5%, 1,027. These are, by the way, I'm just sort of reading out based on the largest volume-led gains. InfoEdge Naukri is up 3% with gains. E2E Networks, 5% gain, 2414 on E2E coming through. Medanta, the hospital company, 3.5%. Carborundum Universal is up 7%, 1,085 there. Chola Holdings is up about 3% or so. And then volumes drop off a cliff. Nothing really. If you go down the list and look at more gainers, I mean, this is the bulk of where we are in terms of volume-led gains coming through. On the downside, JBM Auto had an outsized move yesterday. It's down about 1.5% and large volumes. Colgate is down 3%, is the number one volume-led loser at this stage. Dr. Reddy's is down 2%. VTech Vabag is down 3.5%. And the two refiners we were talking about with Prabal, Chennai Petro and MRPL, both are starting the day down about 2.5–3% lower. So again, large volumes and some gains being taken off here. Nigel?
Just one more stock I wanted to point out. SG Finserv, noted investor Mr. Madhu Kela, went ahead yesterday and bought close to around 10 lakh shares. That one should come up for you on the screen. SG Finserv is now up close to around 15%. Big volumes out there for the initial part of trade. And yesterday, I think to be precise, 9.5 lakh shares or 1.7% stake was picked up by Mr. Madhu Kela. Explains why the stock is flying away. And just one more point. Earlier this morning we said that if the market needs to hold on to this rally that we have seen, and if we need to see a bit of an up move, we need the tech index to participate. And the tech index in this year itself has been a relative underperformer. This morning, it's a big outperformer. It's up 1.4%, and gradually it's approaching that 20 DMA, which is an important, crucial level. So tech is the one that's outperforming this morning, taking over the mantle from the Nifty bank.
Yeah, absolutely. I mean, within the sectoral bounces we saw, the data that we put out, IT has done the worst. So yeah, I mean, there is there is room. Definitely, there is room. I think it remains about 20% off the all-time highs. On the Nifty IT space. Well, we'll talk more about this. Krishna Sangvi is with us, Chief Investment Officer, Equities at Mahindra Manulife Investment Management. Krishna, good morning. Great to have you with us here. Prashant here. I mean, by the way, the market's coming off a little bit. So just about 40 points left now after the massive move we've had from the lows. The question, though, Krishna, is even after, 4,500 point rally on the Bank Nifty, 2,000 point rally on the Nifty from the lows, I don't think it's wrong to ask whether we're completely out of the woods. How would you answer that question, Krishna?
Yeah, hi, Prashant. Actually, markets have taught us that it's clearly impossible to, categorically say we are out of the woods or not. But let's look at the factors, right? So what we've seen in last 6 months, is a multitude of factors. If you look at pure fundamentals, we had a little bit concern on earnings, on economy not, growing as expected a year earlier. The kind of data points we got for Q2 and Q3 was honestly a bit weaker than what we really want as economy. You look at a little bit on the flow side and sentiment side, post election in US, the expectations rose about how US economy can do well, US corporate earnings can pick up because of tax savings, etc. So that's the reason, why across the EMs we saw money moving out and possibly heading to US as a preferred option for some time. And third really was, a little bit pure India-specific liquidity angle, which you call it, about how, new rules of, derivatives, etc. were being played out, or margin trading, etc. So if you look at combination of all three, we saw markets, behave the way they did. Come to, let's say, March this month, I think, the worry started in US actually on reverse side, saying that if they really implement DOGE and if they really implement tariffs the way they plan to, some sort of a worry on US corporate earning growth stroke economy. So that reversal of EM money into DM possibly is what could have reversed is one. And from a economy side, the budget was pretty interesting. We got this this consumer surplus kind of thing and government's action. On top of it, RBI did its own, support by way of rate cut, as well as, really indicating their willingness to, do that extra to really support the growth. I think that factor has changed. The only thing missing in this, really is the pace of change, which is quite fast in a sense. If you just look at last 7 days, we would have rallied nearly 2,000 points. That typically comes more in a rebound or a oversold kind of market. So let's see how it plays out. I think data-wise, quite a bit of oversold or short position would have been reduced by now. Let's wait for Q4 season and then judge based on what the management commentary comes out of economy in 26 for their own companies, as well as little bit support from global markets is required. Last thing, maybe let's not forget, April 2nd is still a relevant date. So that's what we're likely to see some formal announcement from US on the tariff, etc. And how India as a country, stroke a lot of other countries, can get impacted, can be another, things to monitor and then possibly take a call later on.
Krishna, hi, morning. Good to have you on the show. So financials have, become the face of this move that we've seen, right? The recovery from the early March lows. what is the weightage that you're willing to give financials in your portfolios, and within the basket, because it's a very wide basket, what is your preference between banks, NBFCs, private sector PSU, obviously insurance, capital market plays? There's a lot going on there. So just give us the details.
Yeah, sure. So I think if you look at broad positioning financials, clearly it is more domestic economy driven, so would likely to go overweight for now. Basket is huge, whether you call it private banks or, public sector banks or lenders. So broad thought really is, they'll have relative preferences, partly coming from the kind of mandates we run in each of our funds. As you know, quite a bit of large cap has more of banks and NBFCs, while capital market plays, etc., are more into mid and small cap kind of schemes. So broadly, as a house, some of our schemes will be overweight more in capital marketplace, somebody more into NBFCs or financials. So I think combination is what possibly makes sense to be overweight for now.
Hi Krishna, the problem is that Q4 earnings are not going to be great. The hope is that after that we'll see that that earnings will be good. We'll have a low base as well, which will play out. Do you think the markets are prepared to look through a weakish to a muted earnings in Q4 and just be happy with the positive commentary that we're likely to hear? Your take?
Yeah, again, it's difficult to pre-guess, whether markets are ready for all the bad results or weak results. I think some of the companies which have corrected sharply in last 2-3 months, possibly those Q3, so those Q4 outcomes is perhaps captured is my guess. Somewhere, the intensity of the numbers stroke the commentary for FY26 possibly will be a far bigger play. Come to think of it, yes, clearly in the month of March, where we are now, and by May the results are out, more or less markets will be more in a mood to see what they have to say, and report about FY26 outlook rather than so much about Q4. So it will be a mixed bag, I guess. For some companies, if the intensity is pretty poor in terms of numbers of Q4, it might be worry, but otherwise broadly it looks good. Especially for large cap, it looks far better.
Okay, all right, Krishna, let's talk about the two top sectors of the day in the first few minutes. One is tech, where we have seen that index being an underperformer. That's actually outperforming this morning. It's up closer to 1.5%, while the markets are more or less flattish. As well as cement, which is the inward-facing sector, right? Irrespective of what's going to happen on tariffs, the cement demand is more domestic in nature. How do you approach both these two sectors, and what's your current stance?
I think cement is clearly demand is reasonably good. If you're betting on India capex cycle, demand-wise, cement is a pure play commodity which is required, can't be imported. So a domestic play, as you suggested. So clearly positive, overweight call on cement is something I'll say. IT, it's been an underperformer for last, let's say, 2-3 months. In a way, if you look at again the IT cycle of last 6 months, it was stark outperformer as expectations built up for how US economy can pick up in October to December time. IT was a stark outperformer. Once a little bit worry on US came stroke, the tariff. So if I have to really, make a view on IT, I'll prefer to say, let's wait till 2nd April does, IT come into some gamut. I know it's not a product, so, tariff is difficult to use a word there. But is there something else, which might come to possibly, is possibly a worry right now?
I just want to quickly point out that for the first time, I think in at least 4 or 5 days, and 4 or 5 days is how long this market has rallied non-stop, and in a very powerful way, market breadth is turned. This is, again, I mean, we've been trading for half an hour, not even half an hour, and market gains are there. I mean, 65 points in the Nifty, but look at the advanced decline ratio. So 1,400 stocks are lower and about 1,000 stocks are higher. It's nothing dramatic, but, we've had a one-way move, as we've been pointing out, and now you're heading into that, as Krishna has also been pointing out, the 2nd of April. And who knows, if anything, there is only, Trump and his team have been creating chaos and confusion with statement after statement, sometimes meaning this, sometimes meaning that. So very little, there's no firm handle on the extent of it and what may actually happen. Once again, I think this came through clearly in one of the discussions. The impact on India is indirect through weaker global growth, weaker, if tariffs are higher. It's not directly with regards to tariffs imposed on India, even if India has come up in Trump's speeches, etc., multiple times over the last 2 months or so. Look at the market Nifty heat map as well, more evenly matched now, equal number of gainers and equal number of losers as well. Phenolics Cables is another one which is up about 3.5%. It's not there in the mix in the morning and we started, and it's the number one volume-led gainer. And look at two other names which were absent in the morning. HEG is up 13% now, so it's gone up like a rocket. Of course, along with it is graphite, which is up 10%. So HEG and graphite are both surging as we speak. Those are sort of new additions. As I said, still early, just 15 minutes into market open at this point in time. What we'll do is we'll take a quick commercial break here. Krishna, thank you very much for joining us here on the program. Appreciate your thoughts. We'll take a quick break, come back. And okay, I think what we'll do is we'll focus on our next management. Krishna, thank you very much. I think we have the management of NLC ready with us.
Nigel is taking this one.
All right, well, let's focus on the power play. Power demand is expected to peak this summer. Electricity consumption is already on the rise with strong demand in the last 2 months. So is India ready to beat the peak power demand? To discuss this and more, and also focus on business, we're joined by Mr. Prasanna Kumar Motupalli, the Chairman and Managing Director at NLC India. Hi, sir. Good morning. Always good to have you on the show. Tell us, what are the trends you're observing currently with regard to the demand supply? The problem is we are bracing for a bit of a power deficit. Is that the case? Could you tell us your quick word on it?
In the last financial year, in fact, it is in the current financial year, the 250 gigawatt of power requirement was met successfully. And coal and lignite production for supporting that was also good. So in the current next financial year, the power demand is going to increase by around 6 to 7%. That is the forecast. And with the type of production of coal and lignite the country is having, and the power stations stocks are also good, I don't see any problem in meeting the power requirement. In the last 10 years, we traveled from power scarce scenario to power sufficient scenario. So there is no problem in meeting the peak demand that is going to come.
Is it, the thing is, sir, good morning, Prashant here. Of course, I mean, you're well prepared, capacities, etc. But how well prepared is the industry in your opinion, sir? Because every summer, and I think this has been true for many years now, is hotter than the last one. So peak deficits keep rising, right? And into every summer, this becomes a big talking point. Through the summer, it becomes a big talking point. Our capacity is coming up fast enough, sir.
If there is a substantial capacity addition both in thermal as well as renewable power generation, and the whatever growth in power requirement we are expecting 6% to 7%, the capacity addition is more than that, and that is the reason why we can comfortably meet the power demand requirement going forward.
Sir, can you give us some targets on lignite mining? I mean, how are you likely to close FY25, and then what are your overall mining and production targets for as you start planning for the next year as well?
Madam, in the current financial year, we targeted 25 million metric tons. We will be achieving around 92% of that. That was mainly because lignite being a pitted thermal power station, and there were power surrenders because of the rains in the rainy season in the last financial year. This year, next financial year, we are targeting 26 million metric ton, and we are hopeful that we will be doing more than that. And in coal production, this time we achieved more than 16 million metric ton, which is the all-time highest ever coal production. And coal plus lignite also, this is the all-time highest ever coal plus lignite production in the history of NLC India Limited.
Okay. Just a quick update on, some of the capex that you've been undertaking. Ghatampur Unit 2 and 3. If you could tell us about that, and also the Talabira power plant. What are the commissioning timelines for all of these?
In the month of December, we declared COD of unit number 1 of Ghatampur, and we are targeting for COD of unit number 2 in the month of May, and unit number 3 by October. So by October end, the entire station commercial operation will be declared. And coming to Talabira, the contract was awarded to BHEL and works are in fast progress. The land acquisition activities are also in fast progress. So the timeline for Talabira 3 into 800 megawatt is 2030 and 2930 in fact. And Talabira stage 2, that 800 megawatt, that also we are going to tenderize. And the timeline for that is 3031.
All right, let's focus on the renewable part of your business, sir. Could you tell us what is the current capacity? How much of it comes on stream in FY26 and FY27? And since we're talking about renewable, where are you at with regard to the IPO? When do we see that hit the markets?
At present, we are having 1.4 gigawatt solar plus wind capacity. We were the first company to add 1 gigawatt capacity in the country. And subsequently, we are targeting to reach to 10 gigawatt level by 2030. While entire globe is targeting to triple their renewables, we are targeting to increase our renewable capacity 7 times. And efforts are already on for that. Around 2.5 gigawatt of renewable capacity work is in progress in the state of Rajasthan, in the state of Gujarat, and in the state of Tamil Nadu. And we are targeting to achieve more than 50% renewable capacity by 2030. And all works are in fast progress. And recently, we won 2 major tenders in renewables. One wind power tender by SJVN, that is 200 megawatt. And in the tender floated by NTPC Green, we won 450 megawatt, and it is about to be LOA is about to be issued. And we entered an agreement with Assam government for adding a capacity of 1 gigawatt in the state of Assam. And we also entered an agreement with Rajasthan and formed JV for establishing renewable capacity of 2000 gigawatt. With all these things in position, we are sure that we will be achieving the target of 10 gigawatt by 2030. Coming to the IPO, all the actions required for that are in fast progress. And we are expecting in the Q4 of next financial year or Q1 of the 26-27.
And sir, on this IPO, I mean, do you already have a rough sense of the total value of the assets that you will be having in that housing in that entity? I mean, the timelines you've said, Q4 of FY26. And what will be the scale and size of this entity and the total value that perhaps you'll be ascribing to the assets there?
Actually, that's we are still working on that. I think the exact figure we will let you know once we finally calculate that.
Okay.
All right. We'll leave it there, sir. Thank you very much, as always, for taking out the time and joining us here on CNBC-TV18. It's a pleasure. The markets turned right back up. So it gave a little bit of a wobble. And we are back up 130 points once again. 23,789, 23,790. And we are almost at the February highs now. So high is 23,807. We're at 23,785. So 15, 20 points away, the February highs for the Nifty. There you go, the brief dip. Market breadth is still 1:1. It is not 3:1 what we started with. But it looks like broadly the dip has been bought in, at least the first one this morning. Time for a quick commercial break here. We'll come back. We'll speak with the management of Titagarh Wagons on the other side. We'll ask them how execution is looking, both from the company's perspective and, of course, also awards which were tenders, etc., which are being put out by the government. Stay tuned.
Welcome back. So green continues to be the color. Lots of individual stocks in focus. The next company on our radar is actually Titagarh Wagon. The company's got big capex plans, and the outlook for FY26 is just about coming in place. So let's get that conversation going. The company has given long-term EBITDA margin targets of about 13 to 15%. But what about a pickup in execution? Let's discuss this with Pritish Chaudhary, Deputy Managing Director at Titagarh Rail Systems. Mr. Chaudhary, thank you very much for joining in. So, let's actually start there. In Q4, has there been some sort of a pickup in execution? Because while you've had, of course, big plans on the capex side, on the order book side, what about the revenue accretion? I mean, how has it been in the fourth quarter as now you're coming up to end the year?
Sure. So the Q4 has been comparatively compared to a Q3 in terms of the wagon execution better. So as you may be aware, in Q3 there were some issues with the availability of wheel sets, which the entire industry faced, all the wagon manufacturers faced. In Q4, that situation has resolved to some extent, not fully, but it has resolved to some extent, and the production numbers have improved as compared to Q3. But we are still not at that level, that stable run rate level of 1,000 wagons per month, which we intend or which we expect that by Q1, the situation should be normalized.
So Q1, maybe you get back to full normalcy. Right now, it's only partially resolved, which means what? I mean, when you talk about your wagon segment, and let's kind of break this down. Let's talk about, of course, passenger wagons, and also give us an update on the freight segment as well. Will it be sort of a flat end to the year then?
So it would not be flat if you compare it on a year-on-year basis. Compared to the last quarter, the numbers would maybe be even a little higher as far as wagon production is concerned. But as I said, the wheel set issue that prevailed in Q3 did not get entirely resolved in Q4. So a little bit of an impact on account of that is still visible, which will get resolved by Q1. As far as the passenger division is concerned, the availability or the non-availability of wheel sets doesn't really make a difference there because that's not a constraint. On the passenger side, the Ahmedabad Metro and the Surat Metro, as well as the Vande Bharat, are actually in their design phase at the moment. And in the coming financial year, all of those three projects will actually go into execution.
Pritish, hi, good morning. Prashant here. Just to take a point, there was an article 2 days back about this wheel sets issue saying that we are going back to importing wheel sets from China. What's the basic issue? I mean, is it just sort of ramping up capacity here and we're kind of bridging the gap with these imports now? Or what is the gap really?
So the gap was that in the rail wheel factory in Bangalore, they were having some production constraints, the exact details of which are not known to me. But there were some production constraints because of which the levels at which they were aiming to produce at, those levels were not being met. And therefore, there has been a little order placed on China. But as far as the private wagon industry is concerned, the wheel sets were being imported from China and they still are being imported from China. Not just in the case of Titagarh, but in the case of all wagon manufacturers. This import we intend to stop only next year once the wheel factory that we're setting up in a JV with Ramakrishna Forgings, once that's active by Feb or March of 2026, we expect that the import of wheel sets from China, for whether it's for the private wagons or for whatever else, would stop.
All right. Well, hi, Pritesh. Good to have you on the show. Could you give us a couple of numbers, though, in terms of wagons? I think you were aiming for around 12,000, right? So by when do you get to that mark? And for the coming year, what kind of a number should we be looking at?
Sure. So as far as the capacity is concerned and the manpower availability and, the entire infrastructure is concerned, we're already ready and geared to produce at 1,000 wagons per month. It's just a few external factors like the ones we've just been talking about, because of which we haven't been able to breach those levels consistently. As far as this year goes, since we're very close to the end of the year, I will refrain from giving any sort of numbers. But as far as the next year is concerned, we expect to be the standard run rate of 11 to 12,000 wagons.
All right, and you had guided that margins will perk up from here as well. 13 to 15% was the range you were talking about. We see that in FY26?
So the 13 to 15% range is actually on account of the PRS that will be achieved in a few years from now. For the FRS business, for the freight wagon business, an EBITDA level of between 12 to 13% is what we've been guiding, and that is what we'll achieve.
All right, Pratish, in terms of, so for now, I'm assuming in terms of fresh tenders, etc., being put together by the railways, I mean, should we see anything? What should we expect this year, this calendar year?
So, in fact, just this morning, there were some news articles which said that in the next financial, actually, the railway capex is likely to increase by almost 15 to 20%. Now, again, these are media reports, so the veracity of those is yet to be confirmed. But the plans of the railways are very, very clear, the long-term plans of the railways. And in an industry like ours, in a business like ours, we do not expect that every month they'll be ordering or every quarter they'll be ordering. As of now, as far as Titagarh is concerned, our order backlog does see us through the entire next financial year as far as wagons is concerned. As far as Vande Bharat is concerned, it's for the next few financial years, actually. So we expect that before the current orders actually come to a close or start coming to a close, there will be further tenders floated from the railways. On the metro side, however, the story is a little different. On the metro side, since that does not directly fall under the Ministry of Railways, there are new tenders, new lines being announced, new projects being announced almost on a weekly or a fortnightly basis. So the metro market is really booming.
Absolutely. I was just coming to that, Pritesh, because if I look at the Q3 numbers, then the dispatch of metro coaches, and I understand these are lumpy businesses. I mean, this is not like, steady billing. It's not an IT services business. But I think it was only 3, the dispatch over there. So, an overall passenger rail revenue, if I talk about the passenger rail business, and that had come down quite a bit. It had kind of halved in the third quarter. So, if we talk about projections for the new year now, from the metro business, what is going to be the pickup in the business? Your sense of, and we're talking only execution and therefore revenue growth from the metro business and also from the passenger rail segment.
Sure. So we kind of expected the Q3 and the Q4 to be muted on the passenger front because the Pune Metro, which was the only project under execution, is now almost finished. And the Ahmedabad Metro, the Surat Metro, and the Vande Bharat all are in their design phase, which, as I mentioned at the beginning of my conversation, will start execution in the coming financial year. The Bangalore Metro as well, which we're doing in collaboration with CRRC, that the series execution or the series production starts picking up from Q1 of the coming financial as well. So the long story short is that in FY25-26, all the passenger projects that we have that have been in their design phase or in various phases leading up to the execution will actually start execution.
First half or second half, Pritesh? This is going to be more back-ended, second half FY26, or will Q1, Q2 also start showing up, more traction?
So some projects, it will be across the year, ma'am. So Vande Bharat, for example, will be in March of 26. So absolute end of the next financial. Ahmedabad will be around the end of Q1 or beginning of Q2. Surat will be shortly thereafter. Bangalore actually starts from the beginning of Q1 itself. So it's all spread out a little bit, actually.
Okay, all right. Thank you very much, Pritesh, and good speaking with you. That's Titagarh Rail with perspective on their business and, of course, a bit about the industry as well. That wheelsets issue, perhaps still a factor for now for them and other players as well, like Texmaco, etc. as well. But otherwise remain very, very positive. Let's talk about now demand as far as the consumer durables space is concerned. Summer demand is sort of course, starting to pick up in certain categories. We've sort of got that feedback from companies like Blue Star, etc., that we have spoken with. We have Premchand Devarakonda, Chief Financial Officer at Electronics Mart India, and Biju Kurian, Chairman of Retailers Association of India, to give us a sense of how things are looking. Gentlemen, good morning. Good to have both of you here. Prashant here. Mr. Premchand, if I can start with you, sir. Could you give us a sense of how this quarter, Jan to March, is panning out like? I mean, you typically evaluate your business on a Jan to June basis to cut out seasonality. We are, of course, not there yet. We're just at the beginning rather than at the end. But how are things shaping up for you on the consumer durable side?
Good morning. First of all, thank you very much for having me on your show. See, after witnessing a little bit of disappointing third quarter, so this fourth quarter is quite promising, and we did see decent demand for the consumer durables in the fourth quarter of this year. And I think the trend is going to continue further till
Okay, I think Mr. Premchand, can you hear me, sir?
Yeah, now I can hear you. Yeah.
Okay, there was a bit of a scratchy line there. So could you put that in numbers, Mr. Premchand? 9-month same-store sales growth was about 3.8%. You said Q4 is looking very promising. Could you give us what Q4 may look like? I mean, you don't have to give a precise number since the quarter is still on. But 5% plus, what exactly are we looking at? And also, if you can provide us with some targets for same-store sales growth for next year, FY26, sir.
See, SSG, because about more than 65% of our top line is contributed from Hyderabad. So since the base is very high, expecting like a double-digit SSG from Hyderabad region is little. I mean, it's over-optimistic, but we are expecting mid-single-digit SSG coming from Hyderabad cluster, and in other clusters like Telangana and then Andhra Pradesh and North cluster, there we could see a double-digit SSG coming in from these three clusters.
This is for Q4?
Yeah.
So on a blended basis, on an overall basis, what are we looking at? If you can give us a sense.
See, overall for the Q3, it will be on between 5 and 6%.
You mean Jan to March?
Yes, I'm talking about Jan to March.
Okay, and beyond that, I mean, is too early or you have some visibility? Will you be able to improve?
See, for the next year, at the company level, we are expecting mid-single-digit SSG because last year base was very high. That's the reason why it is going to be like mid-single-digit for the next year also.
All right, Mr. Premchand, got that. Stay with us. Let's get in Mr. Biju Kurian as well into the conversation. Hi, Biju. Good morning, and thanks a lot for joining in. What are the demand trends that you have seen so far in Q4 ahead of the summer season? And also, if you could give us your sense, which are the key categories that are doing well and expected to do well?
Well, I think overall, when I take into account all the categories, what we have seen is a very subdued growth in Q4. Now, whether this is because of absolute consumption, whether this is because of the consumer sentiment, and typically the stock market has a very critical role to play in terms of consumer sentiment, all of these have truly affected the way the business has actually turned out in this quarter so far. Some categories, obviously, like food and grocery, has remained steady, mid-single digits in terms of growth. The apparel industry is close to zero in terms of growth. The electronics industry, again, which is largely led by the introduction of new products, as well as the introduction of new occasions. So typically things like a World Cup football, IPL tends to drive some upgradation in terms of purchases, or new mobile phone launches also tend to do that. There hasn't been too much happening in this quarter so far, and I think that has kind of tempered the growth. So as far as the overall retail industry is concerned, we are seeing a relatively stable market, not much of a growth like we had seen earlier. So I think that's the larger RAI view on this.
Okay, so you spoke about two industries, electronics and apparel. Would you be able, in a position, Mr. Kurian, to talk about consumer durables? I mean, large appliances, etc.
Electronics also, includes consumer durables. And what we must see, so when we talk about it, and if you were to look at it segment by segment, the large three categories are televisions, mobile phones, and appliances. Now, televisions largely driven, as I mentioned earlier, by sporting occasions. Mobile phones largely driven by the introduction of new models, which are, really killer models. And then in terms of appliances, it's mostly through penetration and upgradation in households. The penetration and upgradation in households continues to happen. However, appliances as a part of the consumer durables market is a smaller part, while televisions and mobile phones tend to be much larger in terms of contributors. So while appliances have done relatively better, televisions and mobile phones have been slightly weaker in terms of growth, which is the reason why the category as a whole tends to be at maybe between 5 to 8% in terms of like-for-like growth.
Okay, got it. So some slowdown trends quite evident. And you're looking at mid-single same-store sales growth. This mid-single-digit growth has become quite synonymous with most things consumer. Mr. Kurian, if you could just expand on that point, this gradual slowdown in demand that we're seeing, how much is it a function of maybe tighter financing, lesser availability of just funds with households? And do you have reasons to believe that now with the RBI also easing, and obviously now we've got the income tax bonanza as well, do you have reasons to believe that FY26 could be substantially better?
Certainly, there's a lot of hope about the future. But more importantly, I think when we talked about household finance, the RBI has actually come down quite heavily on personal loans. A lot of personal loans were used to drive appliances purchase as well as some durables purchase. So that to some extent has affected because there is both secured and unsecured. So the EMI model continues to work well, whereas the non-EMI model is where there is a bit of a challenge. In terms of general consumer sentiment has been a bit damp. Two reasons. One is that even though you might not be heavily invested in the stock market, but a decline in the stock market tends to bring down the mood of consumers. That's one part of it. And the second part of it is that we've also been hearing some early signs of layoffs in the IT industry, etc. And that is another reason why there is a little bit of concern about job security. So when the future doesn't augur well, then what tends to happen is that the consumers tend to be a bit more conservative in terms of spending, not so willing to be able to open their wallets. So I think that's one part about it. As we go along, and if you were to look at the kind of savings that have happened, and that savings have happened largely in the lower tax brackets, which is up to 10 to 12 lakhs. But if you really look at, where a lot of India's income is, a lot of India's income is actually in the greater than 10 to 12 lakhs. So you do have a part of the middle class which gets covered by the tax savings, but a lot beyond the middle class who are actually drivers of categories like consumer durables still really don't have any tax savings, but for them, really, these tax incentives were not the big driver of purchase. So, the lower middle class, you might see a little bit of impact in terms of consumer appliances penetration levels and purchases. So that's our view. FY26 is expected to be better. A lot will depend on how the rural markets perform. A lot will depend on what happens in urban. So I think we're all looking forward with a lot of anticipation to FY26.
I mean, we can hope, right? That's certainly the case. 1st of April, by the way, those 1 lakh crores worth of tax breaks start to kick in. I mean, it'll show a few months to start to take shape. And maybe on the 9th of April, RBI will cut rates, and that'll be the beginning of a few rate cuts as well. So there are, at the margin, maybe things which are lined up. Mr. Premchand, if you can hear me, sir, you are, as you said, Hyderabad, Telangana, Andhra. I mean, these are all, that's one spot where, which is still, and Mr. Kurian mentioned about some IT layoffs, etc. The one industry which is doing extremely well is global capability centers, GCCs. And every day you hear about some GCC or the other setting up base or wanting to set up base, signing up with the government in that zone, in the markets that you operate in, and on which you're very heavily reliant. Does the underlying sort of consumer remain strong in those markets that you operate in, or is there any weakness there as well? Mr. Premchand. Mr. Premchand, can you hear me, sir? Okay, I think we don't have him. So a bit of a tricky, patchy line. I think we'll wrap up this discussion. Mr. Kurian, thank you very much for the insights. Both of you, by the way, spoke about stock market decline. The market's coming up. So maybe at the margin, that is also a factor which perhaps will work. And we'll see. Thank you for that. Thank you for those insights and appreciate your time here on CNBC-TV18. I think we'll just look at the market, which is up 200 points now. So this is now, I think we need to put bigger targets. I think that's the only way. At 190 points now, 23,847. The February high is come and gone. And this is turning out to be another, super day. Mitesh is back with us. Mitesh, it's a surge. Once again, what would you do?
That's right, Prashant. And in fact, I was looking at the weekly charts on the indices because now the weekly indicators have started turning up. It started with the hourly indicators last week, then the daily indicators, and now the weekly indicators are turning up. Very likely that, we will look at extension of the upside targets in the Nifty to about 24,750, 800 zone. So we now have more space to go up further. But let's not forget the kind of rally which we have had. So again, the idea is that use declines to buy into. Today we got an intraday dip. I would have hoped for more. My best entry point on the Nifty would be around 23,600 in case we get it. If not today, maybe in a day or two. But yeah, I think we're heading much higher and we'll make the sequence of higher highs and higher lows on the hourly to hourly charts. So trade with long buys. Today, I think, some kind of reversal, Prashant, is also seen in the Nifty IT index. So if you look at the IT names, you will find good traction being built up over there. So I have a buy on HCL Tech. It's coming after a long time, but HCL Tech is a buy with a stop below levels of 1630 for targets of 1695. And the other one which I like is Info Edge on Naukri, which I would recommend buying with yesterday's high as the stop loss, which was around 7160, so about a 150 point lower and a target of 7650 on the upside.
All right. Thank you for those trades, Mitesh, and appreciate it. We'll take a quick commercial break here. On the other side, Manisha will focus on commodities, what's top of her mind, coming up in just a bit.
Welcome back. Markets holding strong, and as we pointed out earlier today, the sector to watch is going to be the tech pack. That's the one that's making the big bazooka move today, up close to around 2% or thereabouts. The tech pack comes up for you on the screen. For the time being, let's turn our attention a little bit away from the equity markets and focus on the commodity space. Manisha Gupta is standing by to tell us exactly that. Manisha, take it away.
Thank you for that, Nigel. I'm looking at metals prices because we're looking at very strong gains continuing into this one, and the outperformance clearly coming in from copper, which is very close to its all-time highs. Actually, when you look at the COMEX prices, we're just about 2 cents away from its all-time high of $5.2 per barrel per pound there. So very strong gains continuing into this one. And interestingly, even as on LME, we've seen prices gain up by 13%, but in the COMEX, you have seen prices gain up by 28%. That's the kind of disparity that we have seen on prices, and is the reason you're looking at US copper premium at LME standing at $1,500 a ton there. Well, various supportive factors there. To begin with, it has been about potential US tariffs of 25% perhaps coming in copper, and that has led to a lot of copper being shifted from various other geographies into US. Apart from that, it also is about new stimulus measures coming in from China and more anticipated. And then the markets also are looking at deficit concerns. Almost everybody, all brokings and banks have talked about big deficit in this year and the next as well. The latest report comes in from JP Morgan, which is talking about a big deficit of around 3 million tons every year by 2030. JP Morgan also talks about all-time high prices in this year, and their forecast for copper for this year is $11,500 a ton. Not too far behind is zinc, which, by the way, is an underperformer in this year in the metal space until now, but it also has seen good gains in this week. It's trading at a 3-month highs, and we also are looking at reports coming in from Nyrstar Australia announcing a 25% output cut for the year, and then Alaska Red Dog Mine, which is 10% of where global zinc comes in from, also is looking to scale back because of ore depletion for 2025. The markets also are looking at unprofitable TCs, and that has led to lower production from China, down by nearly 7% in sense of refined zinc production for the year 2024. When you look at 2024 reports as well, it also will tell you that the global zinc output fell for a third straight year in 2024. If the demand starts to come back, then you are looking at zinc prices going higher. Also, when you look at the LME as inventories, LME zinc, high zinc grade inventories have declined by 74,000 tons in this year and stand at 160,000 tons. So everywhere that you look, you are looking at strength continuing in case of prices. One last table should show you on what we've done as this quarter ends in sense of many of these metal prices. These are LME prices, but let me tell you, copper is up 13% on LME. It is 28% higher in the US markets right now. Aluminum, 2.5% higher on LME. It's up 15% in the COMEX markets right now. So that disparity is quite huge as we look at LME and the US markets. Nickel is gained up by 5%. And remember, 25% of those tariffs have come in on aluminum and cobalt as well. So cobalt, which was an underperformer last year, is up 38% in this year. Zinc continues to be an underperformer, and we've seen tin prices gain up by 18% because of inventory declines and production concerns as well. So overall, metal pack slightly taken down by zinc, but otherwise doing quite well.
All right, thanks a lot for that, Manisha. From metals, let's focus on cement. And UBS has gone ahead and upgraded the cement sector. They believe that the rough patch is coming to an end, and so they've upgraded Ultratech Cement, Ambuja, as well as Dalmia to buy. Remember, UBS had a negative view on the sector since July 2023. Due to rising competition, demand slowdown due to general election last year, and also rising price competition after Adani's entry. But now, UBS has done a bit of a U-turn. They've gone ahead, they've turned positive. They anticipate earnings upcycle to emerge from this fiscal onwards. And for the next couple of years, they are focusing on solid EBITDA growth. Their positive stance is backed by demand revival driven by housing upcycle and revival in government capex. The structural cost savings measures, that's what's going to help margins for all these companies. And they're citing bottoming out of prices after the sharp fall we've seen in the 9 months of FY25. Sector consolidation as well has been led by the top two companies, that's Ultratech as well as Ambuja. This chart should come up for you on the screen, and they've given reasons for upgrading the various stocks. Ultratech has shown execution in tough times, both on the growth as well as on margins. Their top pick, though, is Ambuja, because of the higher growth as well as lower valuation. And on Dalmia, they've done a U-turn. They've upgraded the stock from sell to buy, while on ACC, as it is they were positive, they believe that the valuations are supportive and there is an industry tailwind as well. Put all this together, cement stocks are doing quite well in today's trade. Well, time to slip into a short break. On the other side, we'll focus on a special segment. It's the economy. Lata speaks to the head of Credit Bureau, CRIF, on whether MFI loans and unsecured loans are showing less or more defaults. Stay tuned for that conversation.